With plenty of commentary about Australia's record low interest rates, we're joined this morning by fellow director at SmartWealth and the principal here at Smartline Victoria Park, Rob White. Rob, morning and thanks for joining.
Thank you, Justin.
With official rates at record lows, what rate should people be looking or expecting to pay on their either mortgage or in their investment property loans?
Okay, well earlier this month we had the official RBA rate cut of 0.25%, and as is expected usually with a rate cut, banks are not as quick to respond. They generally are with a rate rise. So we saw anywhere between 0.17 and 0.25 roll through the majority of the lending fraternity over the last 2-3 weeks. So where that leaves rates at the moment is on a basic variable, people should really be paying somewhere in the vicinity of about 4.13. Where the average is sort of sitting around with the majors and some of their second tier lenders around about 4.4% on variable. We're seeing fixed rates at the moment, is quite interesting. We're seeing across the board on 1, 2 and 3 year fixed rates are very similar. So they're averaging sort of between 4.2 and 4.7 depending again on the lender. The average would be sitting around about 4.29 to 4.35. So for the first time it is odd to see 1, 2 and 3 year fixed rates very similar.
Yep. And what about if people are paying well in excess of this, say around 5 or above 5? What should they be looking to do?
Well, it depends. If they're in a fixed rate, generally, look, as most people know, they're in a fixed rate. It is a risk of taking a fixed rate that you accept the rate that's on offer at the time. If they're paying anywhere around that in a variable rate, I'd certainly be looking at taking a good look at it. Whether it's talking to their broker or their bank, just do some research because really that is sort of outside where the scope of where they should be at the moment.
Yeah, or talking to yourself, obviously.
Yes, correct.
And the constant question people always ask is, should they be staying on variable or should they be looking to fix at this time?
Probably one of our most commonly asked questions. Again, it depends on every individual is going to have a different situation. And it's also the adversity to risk or not. The benefit of a fixed rate is, as you imagine, for 1, 2, 3, 5, some banks even offer a 7 and a 10 year fixed rate. You can actually lock away that repayment at a set guaranteed repayment over that period of time. Obviously, the downside and risks with a fixed rate is if you fix for a 7 or a 10 year rate, then look, you are quite heavily restricted as to what you can do from there. So if you're looking to sell the property or refinance, it can be restrictive. Variable rates do give you a lot of flexibility around making additional repayments, and that is quite a good option for people to look at now. Is it's taking advantage of the low rates to really pay down debt. So with trying not to be too specific, generally we're recommending people that have a combination of personal or owner-occupied debt and investment debt to possibly look at a blend of maybe moving some of their investment debt to a fixed rate to give them a guaranteed cash flow, but maybe having some openness to a variable rate so they can actually pay down debt.
Yep, and you briefly touched on this, and with the interest rates low, are you favouring people take the opportunity to pay down debt and accelerate that debt repayments, or are you favouring people to take on more debt and basically borrow at these low rates?
No, probably the former. Look, it is quite common for people to get excited by low interest rates. We're just a little bit concerned, I guess, with the current economic climate, what we're seeing, especially around the resource sector in WA, and some news coming out around the bubble in New South Wales possibly about to come off. So we're just saying to all borrowers, just look, make the most of what's there at the moment. We've got cheap access to money. It's a really good opportunity while there is almost the perfect storm. So just take heed of what you've got. We're asking people just really look closely at their personal debt, get their house in order and make the most of the low rate. So generally we say, look, concentrate your efforts on trying to get your personal debt down and get some structure to that so you can really shave the years off that loan before they really go out there again and look at investment. Yeah. Of course, it's a different strategy for people that are in that position or have no personal debt. Well, then access to cheap money always presents opportunities.
Yep. So I'd like to thank Rob for joining us this morning, and this is just one in a series that we're going to provide you with different experts in different fields, accounting, business coaches and the like, just to help you and give you a flavour of the other resources we have available for us here at SmartWealth. So if you want to discuss about your loan or investment loan, just give me a call, 1300 889961, or email me at justin@smartwealth.com.au, and we'll put you through to Rob, and he can basically have a look at what you've got and basically make some adjustments and improve your loans and therefore improve your cash flow so you've got more money to do other things. So until next time, we'll speak soon.